I think Friday turned a lot of people who may have gotten bullish on gold in the last couple of weeks bearish. And that's probably exactly what the Chinese want, right? If the Chinese started this sell-off just by announcing a 1-month hiatus from buying gold, this is going to be, I think, short and sweet. This is a huge bull market, and people are not going to have an opportunity to buy that big a dip. I think 30 for silver is what 2000 was for gold. I think now that we've gone through 30 an ounce, 30 is really the support. Again, we could trade below it like we are now, 29.50, just like gold went below 2,000 many times before it went to 2,400 and hasn't got anywhere near 2,000 since. And I think any dip below 30 is an excellent buying opportunity.
China's central bank paused its gold buying spree last month after 18 months of heavy purchases that had driven gold to a record high in May. There's speculation that China might start selling, which could put further pressure on gold prices. Gold's decline picked up on Friday following a robust U.S. jobs report, which reduced expectations for interest rate cuts this year. Gold prices dropped nearly 1% over the week, marking the third straight weekly decline. China has been increasing its gold reserves since November 2022, leading to a surge in central bank purchases due to rising geopolitical tensions. Analyst Peter Schiff suggests that China's announcement scared off newer, more cautious buyers, giving China an advantage to buy gold with less competition. This change in market sentiment has likely caused many recent investors to exit the market, discouraged by the price drop. For investors to return, gold and silver prices might need to climb significantly, over $2,500 for gold and $35 to $40 for silver. Those who bought silver at higher prices and sold at a loss are likely waiting on the sidelines or shorting the market, risking losses if it rebounds. Analysts predict more selling in the near future, especially with the upcoming Federal Open Market Committee (FOMC) meeting. The Fed is expected to keep interest rates steady, and their dovish press conferences could trigger market reactions that reverse the recent downtrend. However, many analysts, including Peter Schiff, believe the Friday night sell-off will continue briefly into next week. Silver's $30 mark is now a key support level, similar to gold's $2,000. A dip below $30 is a good buying opportunity, though drops to $28 or $27 seem unlikely. Schiff notes the best buying opportunities were under $25, but current levels are still a significant pullback from the $50 highs of 2011 and 1980. The bull market for precious metals remains strong, and savvy investors can benefit from these temporary dips. We will present clips from Peter Schiff's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
And I think Friday turned a lot of people who may have gotten bullish on gold in the last couple of weeks bearish. And that's probably exactly what the Chinese want, right? If the Chinese started this sell-off just by announcing a 1-month hiatus, from buying gold, and that was enough to get the new buyers to throw in the towel, well, now that's more gold for the Chinese to buy. And they got a lot of gold that they need to buy, and they want as little competition as possible. It shows you, what can happen. I don't know what it's going to take now, because so many people that maybe just bought into the market in the last week or two who are now gone, right, and just thrown up their hands in disgust, right? Who knows where they're going to come back in? I mean, maybe gold will have to be well above 2,500. Silver might have to be 35 or 40 before some of the people who just bought, right? Some people finally just saw the move up in silver, and they bought in at maybe 31 or 32, and now they just sold out at 29. They took a loss, and they said, that's it. It's over. I'm getting out. And maybe some people actually got short. They're going to be in for a world of hurt in this next rally. I read a lot of articles. A lot of people think that there's going to be a lot more selling coming. Next week we get the FOMC meeting. The Fed is not going to cut rates, obviously. And they're going to talk. I mean, most of these press conferences have been very bearish. Very dovish. And so we could see a big reaction in the gold market, in the foreign exchange market next week that completely reverses what happened this week. But you still have a lot of people that just assume that the sell-off that started on Friday is just going to continue. It may continue for a day. I mean, maybe we go down again Monday or a little bit Tuesday. But again, this is going to be, I think, short and sweet. This is a huge bull market, and people are not going to have an opportunity to buy that big a dip. I mean, I think what we just saw is about all the opportunity you're going to get. But what these declines do is they're not enough to give the bulls a really great buying opportunity. They're just enough to scare the weak longs and to prevent other people who were considering getting into the market from taking a position because they get scared. And it probably emboldens the shorts, and it probably encourages people to enter the market from the short side. But you're not going to get a big enough dip for the longs, for the bulls, to get a really good sale. I think, these are short and sweet opportunities, and most people will miss them because the market pulls back, and then you're hoping that, okay, maybe we'll get a bigger pullback. I don't want to buy just yet. And the next thing you know, the market's running off to new highs. So I wouldn't expect there to be much downside below where we are now. And again, as I said on a prior podcast, I think 30 for silver is what 2000 was for gold. I think now that we've gone through 30 an ounce, 30 is really the support. Again, we could trade below it like we are now, 29.50, just like gold went below 2000 many times before it went to 2400 and hasn't got anywhere near 2000 since. I think silver is in that early stage. We just blew through 30, which was resistance for many years, which is now relative support. And I think any dip below 30 is an excellent buying opportunity. And I wouldn't press my luck looking for, 28 or 27. I think the time to buy those prices has passed. I was trying to get people to buy silver when it was under 25. But if you didn't buy it when it was under 25, you could still buy it now under 30. 30 is still a big pullback from 50. 50 is where silver got in 2011. And that's where it got in 1980, right? And it's still way below.
No one anticipates that the Federal Reserve will lower interest rates after their meeting on Wednesday. However, economists and investors are keen to discern hints about when the central bank might cut its key rate and how frequently it could do so this year. Since July, the Federal Reserve has kept its benchmark short-term rate steady at a 23-year high of 5.25% to 5.5%. In April, annual inflation eased to 3.4% from the prior month's 3.5%, still above the Fed's 2% target, but notably lower than the two-decade high of 9.1% in June 2022. Peter notes that while the Federal Reserve hasn't yet lowered interest rates, it's widely expected. This expectation stems from the belief that central banks are unlikely to take necessary steps to reduce inflation to their 2% target. In the past, central banks waited for inflation to hit or exceed 2% before acting, even aiming for inflation above 2% to balance out years of lower inflation. However, they now assume that current inflation rates of 3% or 4% will naturally decrease. This shift allows them to justify rate cuts ahead of the anticipated decline. Historically, central banks acted preemptively to prevent inflation from escalating, but recent trends show a departure from this approach, waiting for inflation to become problematic before addressing it.
The Fed, of course, hasn't cut yet, but it's a foregone conclusion that they're going to cut. So the only question is, how soon do they cut? Not, are they going to raise rates? So all this is bullish. None of these central banks is going to do what it takes to bring inflation back down to 2%. They're just not admitting that yet. So they're all trying to pretend that they still have a 2% inflation target and that they're committed to hitting that target. But at the same time, they're easing, they're cutting rates, or they're talking about cutting rates. So their rhetoric, their deeds don't match their rhetoric, right? They're talking the talk, but they're not walking the walk. And so pay attention to what they're doing, not what they're saying. So if they're trying to misdirect you, with their rhetoric, and they're talking about how we're committed to lower inflation on the one hand, but then they're cutting rates, even though inflation is not anywhere near 2%. Now, what are they saying? Well, we just assume that inflation is going to keep falling, and so we can start easing. Well, why didn't they make that assumption when they had rates at 0 or negative and inflation was still below 2%? Why didn't they say, we've printed a lot of money, we've kept interest rates low for a long time, even though inflation is still below 2%, we're going to start hiking now because it's clear that inflation is going to go up, right? It's going to trend higher based on what's in the pipeline. No, they said we need to wait. And in fact, with the Federal Reserve, not only did they wait for inflation to be 2%, they said we want it to be above 2%. We want to make so sure that we're at 2% that we're not going to stop at 2%. That's when they introduced the concept, too, of inflation averaging. They wanted to make up for the years of sub 2% inflation with some years of above 2% inflation. But also, they said they wanted to make sure that the move above 2% stuck, that it wasn't like a fluke. Like we didn't go back above 2%, then come right back down. So they wanted to make real sure. They wanted to stay easier for longer just to make sure that inflation got to 2%. Well, why don't they want to do the same thing now when it's way above 2%? Why are they already assuming that an inflation rate that's 3% or 4% is going to go down to 2%, and so therefore they can start cutting in anticipation of that, right? They don't want to wait to see the whites of the eyes like they did before. They didn't want to anticipate. And in real time, right, I criticized the Fed for what it was saying because prior central banks had always said you can't wait. You can't wait to see the whites of inflation's eyes before firing. You got to anticipate, right? You can't let the inflation genie out of the bottle. That if you wait for inflation to manifest itself, if you let that genie out of the bottle, it is very hard to put it back in. And so therefore you want to err on restraint. So what the Fed should have done, what the ECB should have done, if they really cared about keeping inflation contained at 2%, they should have acted preemptively. But they all said, no, we can't afford to do that. We don't want to take any actions that might unnecessarily harm the economy when we don't have any proof that inflation is 2%. So let's actually wait for the genie to get out of the bottle, and then we'll put it.
As gold rebounds from the recent sell-off, triggered by reports of China's central bank abstaining from gold purchases in May, there's potential for a bullish trend if gold maintains its position above the $2,300 level. This scenario suggests a possible recovery and bullish sentiment shortly for the gold market. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.